Hey guys, I just finished researching 135 REITs, real estate investment trusts, and I wanted to see which 6 would fit into my portfolio. If you want to see the 6 that I came up with, stay tuned. Hey guys, welcome back to the channel. Kevin Burgess here, and I have done some research that I wanted to share with you. If you're interested in real estate investment trusts, I guarantee you're not going to want to miss this. I took the population of 135, yes, 135 REITs, and I came up with criteria that caused me to eliminate and eliminate and eliminate until I got down to what I believe for my portfolio are the best 6 REITs. Now, obviously, these may not be the best REITs for your portfolio, but I wanted to share them with you so that you could take a look at them and see if they would fit into your portfolio. Now, on this channel, we don't just talk about the stocks that we think are the hottest stocks. We actually talk about why we think they are the hottest stocks. So if you're interested in not just figuring out which stocks to click on and maybe purchase, but to understand why they are good stocks, then you've come to the right place. If you like videos like this, please like it and even consider subscribing to the channel. I'd love to have you along for the journey. And without further ado, let's get started. Okay, before I get into REITs, don't click away because what I want to do is talk a little bit about what REITs are. On this channel, we're not just about the hot stocks to buy. We want to understand why they are the top stocks to buy. So I want to talk just briefly, and it won't take long. It might be a little painful, but it won't take long. There are 2 types of REITs. One is an equity REIT, one is a mortgage REIT. An equity REIT actually invests in equity. It invests in properties. And so, think of it like a REIT that would invest in office buildings. They buy these office buildings and then they lease them out. A mortgage REIT actually invests in the debt instrument. So for people who have entered into mortgages to buy their homes, there may be a REIT out there that is buying up those mortgages, and the way they would make money is instead of leasing the property, they are actually collecting the interest off of those mortgages. So that's important to keep in mind. There are equity REITs, mortgage REITs, and then there are some that are a combination of both of those. Now, for me, mortgage REITs have a limited upside. They're kind of capped by the amount of interest on those mortgages, and I'm not really interested in mortgage REITs. I'm more interested in equity REITs. So why should I consider equity REITs, and that's hard to say, equity REITs for my portfolio? First of all, it's a form of real estate investing that you can do without the headaches of renters. I have some rental property in addition to my stock market investments, and there are headaches that come with, the toilet backing up and things like that. So you don't have any of those headaches when you invest in an equity REIT. Point number 2 is that they typically have higher yields. You can see here that REITs are required to pay out about 90% of their earnings. So by doing that, there's a constant flow of dividends. And as these REITs grow and their rentals grow over time, then that's a higher and higher amount of dividend income being paid out to investors. Thirdly, there's a potential for capital gains as real estate values rise. So when these companies go in and they buy these real estate properties, the value of that property when they sell it in the future could add additional value to the REIT. And now I will say this, you don't want a whole portfolio of REITs, but I think sprinkling in some seasoning into the soup of your portfolio with REITs is a good idea. But one thing to note, and I've got this at the bottom of the slide, REIT dividends are non-qualified and therefore they are less tax efficient than qualified dividends. So as a result, many people invest in REITs through their tax advantaged accounts, such as their IRA, or if you happen to have a brokerage account linked to your 401k, you can do it in there as well. Doesn't mean that it's wrong to buy REITs in your after-tax accounts, but just understand that your taxes are going to be a little bit higher on your non-qualified dividends than they would be on a company that paid qualified dividends. So moving right along, I thought I would give you some nerdy stats. I know there are some nerdy people out there that listen to my videos. I mean, why else would you listen to my videos unless you got just a little touch of nerd in you? But I am not an expert on REITs. And so what I needed to do was to get more information around the population of REITs, how many were there, and then come up with a process by which I would narrow down the REITs that I wanted to invest in. And I've actually ended up with 6 REITs that I want to share with you. But here's some nerdy stats about the process that I went through. My screener pulled 135. Yes, 135 potential REITs for investment. And they had a market cap of $1.2 trillion. There is an insane amount of money invested in REITs these days. But obviously, 135 REITs, I mean, come on, you can't invest in that many REITs. So I had to narrow this down to a population that was manageable. So I had to come up with some ways to kind of narrow that population down. And here's what they were. The first one is I eliminated REITs that had a Simply Safe dividend score of less than 60. There were 80 of these 135 REITs that were below 60 in their Simply Safe dividend score. So those are gone. That left me with about 55. Then I eliminated REITs that had a yield of less than 4%. One of the ways REITs provides value to us is through the yield. And so if we're not getting yield, then why invest in that REIT unless we think there's going to be some kind of growth in the future for that REIT? So therefore, I've gotten rid of 99 of the 135 in these 2 eliminations. The third one is that I eliminated any REIT that didn't have a growth streak of at least 5 years, a dividend growth streak. Now we're at 118 of the 135 that got eliminated. So that leaves me with 17 REITs, but that's still a lot of research and a lot of due diligence to do. So I then began a deeper dive into those 17, and I looked at a lot of different metrics. So I looked at these other criteria, and I eliminated 11 more based on things like credit rating, the diversification of their portfolio, whether I thought their valuation was too high. And so that left me then with 6 REITs that I want to talk about today. They have about $103 million of market cap. So without further ado, let's get into these 6 REITs that are favorites of mine now. And I'm going to go through them in descending Simply Safe dividend rating score. So here we go. Top on the list, the highest rated dividend safety score for the 6 REITs that I want to talk about today is Digital Realty Trust, ticker symbol DLR. They have a dividend yield of 4.6%, a dividend safety score of 94 out of 99. They, in March of 22, grew their dividend by 5.2%. So this is a specialized REIT. It is, as you can probably tell by the title, the term digital. It's in the IT space. Let's talk a little bit about that. They have, in terms of diversification, they have about 4,000 plus customers in 50 plus metros, 300 plus data centers. You can look down here at the bottom and see that they are even geographically diversified. They've got about 60% of their business in North America and 40% in elsewhere in the world. They've got a variety of customer types. They are the 8th largest publicly traded REIT in the country, and they are actually in the S&P 500. They have an S&P credit rating of BBB, which is 2 steps above investment grade. So I believe that they are diversified in their offerings, in their customers, in their geography, and they are a pretty solid dividend REIT. So my second favorite REIT, and again in descending order, is Essex Property Trust, ticker symbol ESS. They have a dividend yield of 4.03%, so they barely made the cut, but they have a dividend safety score of 93. Their last dividend increase was 5.3% in February of 22. Looks like they may be on tap to raise dividends again. They are a residential REIT, which means they buy, apartment buildings and things like that. So let's look a little bit more under the hood. They are mainly located on the West Coast, which they tout here as having the fifth highest GDP in the world, which is probably true, actually. So they have about 253 apartment communities, 62,000 apartment homes. That's a lot of units to rent out. The third REIT that I want to talk about today, and I think my friend Ryan Williams is going to enjoy this, is Kilroy Realty, ticker symbol KRC. It is an office REIT. It's got a dividend yield of 5.33%. Now, its dividend growth in September was only about 3.8%, but it's still a pretty decent growth. They have a dividend safety score of 70. So let's look at them a little bit more in detail. They are really more focused on sustainability. So if that's a big issue for you, then this is a good REIT to have. They are focused on, the sustainability of, new office buildings and things like that. They position them where you can walk to various venues, events, and even, amenities that are in the cities. So they are well-positioned businesses. They focus in really 5 areas: San Diego, Los Angeles, San Francisco / Bay Area, Seattle, and then Austin, Texas. So I'm not sure how you go from the West Coast to Austin, Texas, but at least they're beginning to diversify more geographically. So now my fourth favorite REIT is National Retail Properties, ticker symbol NNN. Dividend yield is about 4.6%. They have a dividend safety score of 70, and their dividend growth in July of 22 was 3.8%. A little bit more about them is they are really well diversified. They are mainly, and I'll talk about this second point first, they are concentrated in the restaurant, convenience store, and automotive service sectors. They have 3,349 properties in 48 states with a gross leasable area of approximately, get this, 34.3 million square feet. That's a lot of square feet. Now, this bottom box here I thought was really interesting because Simply Safe Dividends usually will give the facts, and they don't offer a lot of opinions. But I thought this was interesting. They said overall, National Retail has proven itself to be among the best in its industry thanks to its prudent management team, strong balance sheet, mostly e-commerce proof tenant base, meaningful diversification, and ability to grow its payout in just about any economic and interest rate environment. Again, National Retail Properties is one of my favorites. Now, my fifth favorite REIT is Realty Income, ticker symbol O. There's a lot of YouTube videos about Realty Income. They are self-proclaimed the monthly dividend REIT because they pay their dividend on a monthly basis. They have a dividend yield of around 4.5%, a dividend safety score of 70. They don't grow their dividend really quickly. So let's look at some of their details. They seem to be pretty well diversified as well. They have 1,147 clients in 79 industries. They, utilize all 50 states, and they tout 27 consecutive years of rising dividends. So that's a pretty good track record. Moving along into some of their portfolio here, you can see their largest customer is Dollar General. Then they've got Walgreens, 7-Eleven, Dollar Tree, FedEx. So they got good customer diversification. They also have good industry diversification. They have property type diversification and geographic diversification. So they are a pretty well diversified REIT. Number 6 on the list is National Storage, ticker symbol NSA. They are a specialized REIT, and their specialization is in mini storages. They have a dividend yield of 5.8%. A dividend safety score barely made the cut at 60, but they had a dividend growth over the last couple of years of 18%. They are growing really quickly. Let's look behind the scenes a little bit. They have about 71.5 million rentable square feet, 1,100 properties. And you can see some of the brand names for their properties here. They seem to have a pretty big concentration in Texas. Maybe the secondary level would be Georgia, Florida, California, and Oregon. And then you can see that they're in a lot of the states, but not all of them. I'm going to change the structure of my portfolio. I'm going to take the IRA that was focused on options. I was, looking at doing options, and I was selling covered calls and some cash secured puts, and trying to get into the options scene. And what I found out was I don't really like options that much. They take a lot of time, and they take a lot of care and feeding, and you have to stay with them pretty much every day. So that to me is not really passive income. This channel is about passive income. So I am going to, I may still do some options, but it's not going to be a lot. So I'm going to change the focus of my IRA, which is about $33,000, from options into REITs and BDCs. And as we talked about earlier, REITs and BDCs are non-qualified dividends, so putting them in my IRA makes a ton of sense. Therefore, I plan to invest in my 6 favorite REITs this week. And also, I'm waiting on being able to reinvest into my favorite BDC, which, as we talked about on the last video, is Main Street Capital. And I'm going to put all 7 of those, 6 of the REITs, 1 BDC, into this $33,000 IRA portfolio, and we're going to track that over time. So that does it. Those are my 6 favorite REITs, and I know that there are a lot of REITs that I cut out to come down to my 6. And so there are some good REITs that I just don't have in my top 6. So if you have a particular REIT that you like and want to know why I didn't include it in my top 6, leave me a note in the comments below, and I'll be glad to share with you my thought process around any particular REIT that you are interested in. So if you're still listening to this, I'm glad you're here. I really enjoy sharing what I've learned as I research stocks and REITs and BDCs. So I'm glad you're here. I love sharing this information with you. And with that, I will see you on the next video.